Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we were working on the theory for Chapter 7, which was on cash and accounts receivables. However, if you watch the previous video, you'll see that for the assignment for Chapter 7, it had also included that you look at Appendix B, which was about the time of value of money. And that was what we covered in the previous video. In this video, you were also assigned to look at Appendix 7A, all right, which is about petty cash. And Appendix 7A, follows immediately after Chapter 7, whereas Appendix B on the time of value of money is at the end of the textbook. So if you, for whatever reason, you just didn't notice when you were reading the digital study guide that you had to also include Appendix 7A on the petty cash, or Appendix B, the time value of money, be sure to go back into the textbook and read that information. All right. So this video is talking strictly about a petty cash fund. Now, petty cash fund. All right. On our chart of accounts, the petty cash account, first we have cash, and then we have petty cash. Okay, and then after that, it's either marketable securities or accounts receivable, and then you have inventory, right? So that's kind of like where the petty cash falls, immediately right after cash. Now, here's the thing about petty cash. When you have a business, the business, businesses want to operate using checks, okay? Because in using checks, you're able to document and have a paper trail of all the transactions that occur. I mean, every transaction that happens in a business needs to be documented, quantified, and recorded, okay? But if you're dealing with cash, it's very difficult to do that, all right? It's too easy just to pay something with cash and not get a receipt, all right? So for the most part, businesses use checks, but it makes no sense to write a check for, let's just say, a newspaper that costs $1, right? You're not going to go to the newsstand and write a check, right? You're going to pull out your money and you're going to pay the $1 for the newspaper. The guy who comes to clean the windows and he charges you $5 to clean the windows, you're not going to write a check for him. You're going to write it. You're going to, you need $5 and you're going to pay him, right? But the thing is, so all of these here very, very small transactions that are inconvenient to be writing checks for, you're going to be using cash. But the bottom line is that even if you buy that newspaper from the newspaper stand, you need a receipt. And the same thing with the guy who washes the windows. You get a receipt, right? Now, the issue comes in that, well, you have let's say there's an owner and you have a salesperson, right? And you might have, say, a manager, right? You have a lot of people who need things, and they're going to be smaller ticket items, smaller amounts, and they're going to be paying cash. So how do you handle this, right? Well, that's where the petty cash fund comes in. What you do is you have to set up the petty cash. Now remember, I said my chart of accounts has cash, and let's say my cash has $10,392.54 in it. Well, I'm going to set up a petty cash account. And then let's say my accounts receivable has $3,275 in it, right? I'm going to set up a petty cash account. And what I'm going to do is I'm going to sit there and I'm going to think, well, how much do I need in the course of an accounting period, right? And let's say that you determine that you need $500. So you're going to get a box. This is a box, and you're going to put the $500 into the box, right? Well, how do you do that? You write a check right, made out to cash for $500, and you go cash it at the bank. Now notice you have a check, right? And since it's a transaction, what you're going to do is you're going to have to record that transaction. So remember, your cash is going to decrease, right? So that's a credit to cash for $500, and you're going to debit your petty cash, okay, for $500. So when you make this journal entry and you post it to your ledger accounts, I'm sorry, let me change this amount here and make it 892. So when you make this journal entry and you post it to the general ledger accounts, now your petty cash is going to have $500 in it, okay, and your cash account is only going to have $10,392. So we've effectively moved, from the bank account to our petty cash. Now the thing about this $500, it's what's called an impressed account or amount, right? And what that means is it should not change. I mean, you start out with an amount. In this case here, we want $500, right? If for some reason it's not enough, okay, we can increase it or we can decrease it, right? But generally, the only transactions that go into the petty cash account are the initial funding of the account or any additional fundings of the account or decreases in the account. It is not meant to record our expenses, all right? So whatever you've determined your petty cash to be, all right, that amount, the $500, is always going to stay the same. No more transactions will ever go into that account unless, like I said, you have to increase it. And let's say you had to increase it to $700, all right? So then I would debit my petty cash for $200, right, and credit my cash because I wrote a check for $200, and now my petty cash would be, erase that there. My petty cash would be $700, and my cash would be $10,192, right? Because I moved the $200. So I can have these. These are the journal entries that allow me to create my petty cash impressed amount. Now, obviously that's cash, right? And I stick it in a box or a safe or a cash drawer, someplace that it's controlled, okay? And of course, you have to have your internal controls in that respect, all right? So in other words, you don't just want anybody to be able to go into that box, all right? You only want certain people to be able to go into that box. And of course, when they go in that box, if you're going to take any money out of that box, you have to have a receipt for that amount that you put it back into the box so that that petty cash always, what's in that box always totals $700. So how does that work? Well, let's just use the $5 for the window cleaning, right? Again, you have, this box is controlled, so maybe only, the manager has access to it and it's in the accounting office, or maybe, the controller or the business manager in the accounting office, if somebody needs that money, they have to come to the accounting office. That person who's responsible for that box will then say, okay, let me see the receipt, right, for $5. And when they have the receipt for the $5, they'll take $5 in cash out of the box and put the $5 receipt into the box, right? So when they do that, the box has now $695 in cash and a receipt for $5 for window cleaning, okay? And that's all basically that you do. Every time that something happens, okay, let's say a salesman goes and he fills up his car, right, with gas, and he has a $35 receipt for, all right, so let me write this down here. $5 for window cleaning. Let's say the salesman, $35. He gives you a receipt for gas for his car. Okay. Well, when he does that, let me do it like this. Here's my cash side, and here's my receipts. Okay, so you started out with $700 in cash, right? Okay, $5 for window cleaning. So now my cash is $6.95, and I have $5 in receipts. Now I get a receipt for gas. So I take $35 out of the box. So now I have $660 of cash, and I have a $35 receipt in the box. Okay, so these two all make up that 700 when I add them all up, right? So here I have $40 in receipts and I have $660 in cash, right? So that's $700. And what happens is you keep on doing this as you need, for all of these small little things, maybe the owner went and he needed to buy some office supplies and he spent $15 for pencils, papers, tablets, whatever, right? So now he has $645 of cash and a $15 receipt in the box. All right. So during the course of business, right, during the accounting period, this is what ends up happening. As the receipts go into the cash gets taken out, they're replaced with the receipts. Now, to make things simple here, I'm not going to go, $700, you get an awful lot of receipts here, right? But let's just, to make things short, I mean, obviously, as you get nearer and nearer, let's say you only have like $150 left in cash in the box, you might want to replenish the cash in the box. Okay, at the end of the accounting period, you always replenish the box, right? Why? Because you have to expense these receipts, right? They were transactions that occurred during the month that you haven't expensed yet, and those receipts need to get on the books. So at the very least, at the end of every accounting period, you have to replenish that petty cash fund so that there's $700 in cash, and you're able to expense these receipts. And you'll see me do that in just a second. So the idea here is that as you go through the month, if you start to get low on cash, right, then you want to replenish the cash. And to do that, you're going to write a check for the total amount of the receipts, right? So, and then of course you cash it at the bank, okay? And you'll get that cash and you'll put it back in the box, and all of those receipts are going to be attached to the check. So, let's say 3 weeks in, you're short, you have to replenish the cash. Well, you replenish the cash. And then 1 week later, at the end of the accounting period, if there's any receipts still in that petty cash box, you need to replenish the petty cash box at the end of the accounting period, so that all of the expenses are in that accounting period. Now, I'm not going to make up, a whole ton of petty cash transactions here just to be able to get my cash to be low, right? I'm going to say, for whatever reason, this was a really, 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 really slow month, okay? We went on vacation, business was closed, whatever, okay? But at the end of the accounting period, when we look in this petty cash box, we have $645 in cash, and we have, let's see, that's $55 in receipts, okay? This is $55 in receipts, right? So what do we need to do? We need to replenish that petty cash fund. So we go and we add up all of our receipts and we write a check for $55, right? And we go to the bank and we cash the check, okay? And when we cash the check, now we put that money back into the petty cash box, and now our petty cash box has, again, $700 in cash and no receipts, all right? So, we're going to put that $55 back in so that our petty cash box has the $700 in cash. Now, we have this here check, okay? And this here check for $55, obviously, with it, since a check is cash, we're going to credit our cash account for the 55, right? We have to journalize this check. So we make a journal entry. Maybe I should do it over here where there's a little bit more space. Okay, so we have to journalize this here check. We have to make a journal entry for the check. Well, what's a check? Money going out. Is cash increase or decreasing? It's decreasing, so we credit our cash for 55. But we also have to make debits. Okay, well, what are our debits for? How are we, debits have to equal credits, so we have to debit something else. Well, what are we going to debit? What we do is we look at our receipts, right? We look at our receipts and we decide for each expense, for each receipt, where we're going to expense it. So let's just say for this window cleaning, we generally put that to miscellaneous expense. And then let's say for gas, we put this to auto expense. And the office supplies, we put this to office supplies expense. So that's what we do. We go down through each and every receipt and determine what expense it is, and we write that expense on the receipt itself. Now, we take all of those receipts and we attach them to the check, which was for $55, right? So we're going to take all of those receipts and we're going to attach it to the check. When we're coding the check, because we've coded, we're making the journal entry, we know that for window cleaning, all right, we're going to have a debit to miscellaneous expense for $5. We're going to have a debit to auto expense for $35. And we're going to have a debit to office supplies expense for $15. Okay, so that now becomes our journal entry that we're going to put in our journal and then post to our general ledger accounts. Okay, think of it as, from the perspective of, okay, if I were going to write a check, say, for rent expense, well, I'd write it, let's say it's $1,000. What I'd write, when I write the check, I'm crediting my cash for $1,000 and I'm debiting the expense, rent expense. Well, this is no different. Okay, the only thing that's different is that instead of having just one expense account, we have a whole bunch of receipts, and we have to decide where each and every receipt goes in our expense accounts. Maybe I might have 2 or 3 receipts for gas. Well, I total them all up, and instead of having $35, let's say it's $75. Okay, well, then I have a debit to auto expense for $75, right? I mean, you don't, this journal entry can be rather large. It's going to be multi-line. It's not unusual to have 7, 8, 9, 10 line entries for this one journal entry. But remember, what are we doing? We're replenishing that cash by writing the check. So when we write the check, that's when we have to make the journal entry. All right. And then once you've made the journal entry, you just post it to your books just like anything else. Okay. So as a recap, what we do is we have to initially fund our petty cash account. So we write a check and we get the cash, and for whatever amount that is. If we have to increase it, we write another check and increase it. But the only when you're putting funds into the account, that or you take funds out of the account, that's the only time that the balance of our petty cash account should change. So really, if you're funded for $700, a year later, it should still only have $700 in it, all right? And there should be no additional transactions that hit the petty cash account. Some students think that when they go to replenish the petty cash, that they use the petty cash account. No, you don't use the petty cash account. Because you're writing a check, it comes out of the cash account, right? That petty cash always stays the same. So you put the money into the box, right? And you have to have your internal controls in order to keep track of that cash. Whether it's a two-person system, restricted access, things like this, all right, you need some kind of control over that petty cash. You can't just let anybody go into that box or into the cash register, into the safe, wherever you're keeping it, right? You need some kind of restricted access, some kind of internal controls. You have the money into that box, into the petty cash fund. Every time someone needs petty cash, because they're going to be paying something relatively small and it makes no sense to write a check for it, they need to get a receipt. And when you put the receipt into the box, you take the cash out. So the box always has a total amount of whatever the impressed amount is. In this case here, we're looking at $700, right? So our cash plus our receipts will always equal whatever that impressed amount is. After some time, our cash will dwindle and we'll need to replenish it. Or we get to the end of the accounting period, and since we need to expense our receipts, well, we'll need to have to replenish that cash. To do that, we write a check. And when we write the check, we attach all of the receipts to that check. Well, because we write we cash the check, we get the cash and we put it back in the box, and we take all of those receipts out. So $700 should be back in the box, and then we have all of these receipts. Well, these receipts get attached to the check, and we have to make a journal entry for the check. Making the journal entry for the check is no different than a credit to cash and a debit to rent expense when you're paying rent with a check. The only difference is that instead of having one receipt, you might have 45 receipts, and you have to look at each individual receipt and determine what expense account it belongs to, right? And when you do that, you end up with a whole bunch of debits and one credit, right? But that's what the journal entry is made up of, and that's what you post to your general ledger accounts. And really, that's about it for the petty cash fund, right? Go ahead and read. It talks about replenishing the petty cash and changing the petty cash fund. I talked about increasing the petty cash. Well, decreasing the petty cash is basically, like let's say we have $700 and we find that we only use $300. Okay, we basically only use $300 during the course of a month. Well, I don't want to have the extra $400 sitting in that box. At first, we thought, we'd need 7. We only need 3. Well, what we do is then we just take the $400 out of the petty cash, right? And put it into our cash account. So we'd end up debiting our cash for $400 and crediting our petty cash for the $400, right? And that would reduce our petty cash fund, our impressed amount, to only $300. So this would be $300, and this would be now 4 and 1 is 5. All right, so that would be, we'd increase our cash when we post that journal entry. When you're setting up the petty cash, it's better to start out small and increase it. If you're not sure, start out with only $200. And if you find yourself needing more and more, and you keep on having to replenish it several times during a month, okay, then maybe the next month add an additional 100 or 200, and then if you still need more, add the 100 or 200, and you'll get a general idea as to how much you spend, from a petty cash perspective during the course of a month. And you kind of like say, okay, I'm spending right around $600, so let me make it $700, so I have enough in there, okay, and I'm not running out. It's just extra work to always be cutting a check, all right. And like I said, you really only, I mean, ideally, you should have enough cash in the petty cash fund in order to cover all of those petty cashes for the entire accounting period, so that when you get to the end of the accounting period, um, and you have to expense all of those receipts, so you replenish it at that time in order to make that journal entry. But it doesn't make sense to put $2,000 into the petty cash fund when you're only going to use 300, right? You have $1,700 sitting there that could be used better in your business. All right. So that's it for the petty cash fund, and that's it for all of the theory for this particular lesson that was assigned in the digital study guide. So with that, you'll start seeing me working on the assigned homework problems in the next set of videos. If you have any questions about this, feel free to, contact an instructor. Okay.